I told you. I specifically told you not to panic. I told you the dip to $77 was nothing but a coordinated liquidity grab designed to shake out weak hands before the next explosive move higher. And what happened today? January 6th, 2026, New York trading session, silver broke back above $80 per ounce. We touched 80.20 at the session high. The correction is over, the liquidity grab is complete, and the institutions that engineered that drop are now positioned for the move to $84 that is happening as we speak. If you sold your silver during that dip, if you panicked when price dropped from 84 to 77, if you believed the headlines telling you the rally was over, you just handed your metal to the smartest players in the market at a discount, and they are laughing all the way to the vault. Let me be very clear about what just occurred and what is about to happen next. The pullback from $84 to $77 had nothing to do with fundamentals. China did not stop buying. The Pentagon did not cancel their $7.4 billion smelter project. Industrial demand did not collapse. The supply deficit did not suddenly reverse. Nothing changed except the price on your screen. And that price action was engineered specifically to trigger stop losses, force margin liquidations, and create panics selling from retail traders who do not understand how institutional money operates. While retail was selling, institutions were buying. Every single ounce that retail dumped below $80 was absorbed by players who understand that the structural shortage is real and the price is going much higher. Today's move back above $80 is confirmation that the manipulation is complete. The dip served its purpose. The weak hands have been cleared out. The liquidity has been grabbed. And now the path to $84 is clear. But before we talk about what happens when we break 84, let me explain exactly why that dip occurred and why it was predictable if you understand market mechanics. Silver had gone from $70 to $84 in less than 2 weeks. That is a 20% move in an asset that typically moves slowly. The rally was fast, vertical, and fueled by genuine panic buying from industrial users who realized that Chinese export restrictions were creating a physical shortage. But here is what most people do not understand. When an asset moves that fast, it creates an opportunity for manipulation. Every retail trader who bought silver during that rally placed a stop loss somewhere below their entry. Maybe at $78, maybe at $75, maybe at $70. Those stop losses are visible to institutional players. Exchanges can see where they are clustered. Market makers know exactly where the pain is concentrated. And when there is enough stop loss liquidity sitting below the current price, institutions will push the price down to trigger those stops, force traders to sell, and then buy what those traders are dumping at discounted prices. This is not a conspiracy theory. This is standard operating procedure in commodity markets. It happens in crude oil, in gold, in copper, in every market where leverage and stop losses create liquidation cascades. The drop from 84 to 77 triggered billions of dollars in stop losses. Margin calls forced leveraged traders to liquidate positions. Panic spread on social media. Reddit was full of posts about how the bull market was over, how people should have taken profits, how silver always does this, how they were never going to trust precious metals again. And while that panic was spreading, while retail was capitulating, institutional buyers were absorbing every ounce. JP Morgan, the United States Department of Defense procurement agencies, Chinese state-owned enterprises, they were all buying. They knew the fundamentals had not changed. They knew the shortage was still real. They knew the price was going higher. So they used the opportunity to accumulate at $77 what they would have had to pay $84 for just days earlier. And now that the accumulation is complete, now that the stop losses have been triggered and the weak hands have sold, the price is moving back up. $80 today, $84 by the end of this week. And then the real move begins. Because when we break 84 with conviction, when we close a daily candle above that level, every trend following algorithm on the planet flips bullish. Every hedge fund that shorted silver at 80 thinking they were smart scrambles to cover. Every retail trader who sold at 77 tries to buy back in. And the combination of short covering, algorithmic buying, and retail FOMO creates a buying wave that overwhelms selling pressure and propels the price vertical. Let me show you what is happening beneath the surface. What the mainstream financial media is not telling you, what the banks do not want you to understand. The reason silver is going to $100, $200, $300 has nothing to do with technical analysis or chart patterns or RSI readings. It has everything to do with three structural forces that are colliding simultaneously for the first time in 50 years. Physical supply shortage, government resource nationalism, and the breakdown of the paper pricing system. Let's examine each of these forces individually and then show you how they interact to create the perfect storm that is about to send silver vertical. First, the physical shortage. Global silver demand in 2025 was approximately 1.24 billion ounces. Global supply, including mining and recycling, was 1.01 billion ounces. That is a deficit of 230 million ounces in a single year. This is not a new phenomenon. This is the fifth consecutive year of structural deficit. For 5 years, the world has consumed more silver than it produces, and it has filled that gap by draining above-ground stockpiles. But stockpiles are not infinite. COMEX registered inventory is currently at 93 million ounces. That inventory has been falling at an average rate of 2 million ounces per day since December. At that depletion rate, COMEX will have zero registered inventory by the end of January. Zero. And when registered inventory hits zero, the exchange cannot deliver physical metal to contract holders who demand delivery. They will be forced to declare force majeure or change settlement rules to cash only or halt trading entirely. The London Bullion Market Association vaults have lost 40% of their silver holdings since 2020. Shanghai Futures Exchange inventories fell below 500 tons in November, the lowest level in 10 years. These are not isolated data points. This is a global trend. Physical silver is disappearing from exchanges faster than mining can replace it. And that disappearance is accelerating, not slowing. Industrial users are panic buying to secure supply. Investment demand is surging as people realize paper contracts are not the same as metal in a vault. And governments are implementing resource nationalism policies to ensure domestic industries have access to critical materials. All of this creates relentless buying pressure that cannot be satisfied by current production rates. Second, government resource nationalism. On December 15, 2025, the United States Department of Defense signed a $7.4 billion deal to build a critical minerals processing facility in Clarksville, Tennessee, in partnership with Korea Zinc. This is the first major non-ferrous metal smelter to be built on American soil since the 1970s. For 50 years, the United States was content to let China process its metals. But now, in the middle of a silver squeeze, Uncle Sam is dropping $7.4 billion to bring processing home. Why? Because Chinese export controls that went into effect January 1st have cut off Western access to refined silver. And without refined silver, the United States cannot build the weapon systems needed to maintain military dominance. The Pentagon is taking a 40% equity stake in this smelter. They are not just a customer, they are an owner. This means the silver produced by this facility is not going to the open market. It is going straight to U.S. military stockpiles. It is being removed from commercial supply before it even hits the market. Think about what this means. The most powerful military on Earth just admitted with a $7.4 billion check that silver is so strategically critical they cannot trust the market to provide it. They have to own the supply chain directly. This is not a market transaction. This is a national security imperative. And if the Pentagon is panicking about silver supply, what does that tell you about where the price is going? But the United States is not alone. China implemented silver export restrictions on January 1st. Only 44 companies are licensed to export silver, down from hundreds previously. Those licensed exporters must produce at least 80 tons annually and maintain $30 million in credit lines. This effectively shuts down small and mid-sized refiners and consolidates control with state-backed enterprises. China produces 60 to 70% of the world's refined silver. By restricting exports, they are ensuring domestic industries have priority access. They are weaponizing silver as part of their broader strategy to dominate 21st century technologies. Solar panels, electric vehicles, 5G infrastructure, artificial intelligence data centers, all require silver. And China has decided they are not going to export the silver needed to compete with them. Third, the breakdown of the paper pricing system. For 50 years, New York and London dictated silver prices to the world through paper contracts traded on COMEX and the London Bullion market. If New York said silver was worth $70, it was worth $70 everywhere. But that system is breaking. Today, there are two prices for silver. The paper price in New York, currently around $80, and the physical price in Shanghai, currently above $82. This morning's close on the Shanghai Futures Exchange showed silver at 18,420 yuan per kilogram. Converting to dollars and troy ounces at the current exchange rate of 7.1 yuan per dollar gives you approximately $82 per ounce. This $2 spread between New York and Shanghai is not temporary. It is structural. It represents the difference between a market where participants trade contracts with no intention of taking delivery and a market where factories need actual metal to operate and will pay whatever it takes to secure supply. The Shanghai premium proves that physical buyers in the East are setting the real price, and paper traders in the West are scrambling to catch up. This is the death of Western price control. For decades, banks could suppress silver prices by selling unlimited paper contracts on COMEX. But now, with China buying physical and refusing to accept paper promises, that suppression mechanism is failing. The arbitrage between New York and Shanghai creates constant buying pressure as traders buy in New York, ship to Shanghai, and pocket the premium. This dynamic drains COMEX inventory, forces the paper price higher, and eventually leads to a complete breakdown when the exchange runs out of metal to deliver. We are weeks away from that breakdown, maybe days. And when it happens, when COMEX declares force majeure or suspends deliveries, the paper market will lose all credibility. Price discovery will shift entirely to physical markets, and the price in physical markets, where supply is genuinely scarce and demand is desperate, will be far higher than $80. How much higher? Bank of America just issued a research note forecasting silver could reach $309 per ounce. Goldman Sachs raised their target. JP Morgan, the largest shorter in history, is now financing the Pentagon's $7.4 billion Smelter project. The banks that manipulated silver for decades are capitulating and flipping bullish. Now let me connect all of this to what happens next. Silver hit $80 today. Over the next 2 to 3 days, we consolidate between $78 and $81. Weak hands will sell, strong hands will accumulate. Then, probably by Friday or early next week, we assault $84. When we break 84 with conviction, when we print a daily close above that level, the cascade begins. Every algorithm flips bullish. Every short scrambles to cover. Every retail trader who sold tries to get back in. The buying pressure overwhelms selling by a factor of 10 to 1. From 84 to 100 takes maybe a week. From 100 to 120 takes another week. The move accelerates because short covering intensifies. By February, we are looking at 150. By March, 200. By summer, 300. But here's the critical point. The exact price does not matter as much as understanding what is really happening. This is not about trading. This is about nations securing strategic resources in preparation for a monetary reset. China is not day trading silver. They are implementing a multi-decade plan to ensure they have the materials needed for industrial dominance. The Pentagon is not speculating. They are securing supply chains for national defense. JP Morgan is not playing price games anymore. They are pivoting from paper manipulation to physical control. These are the smartest, most powerful entities on Earth. And they are all accumulating silver. They are betting trillions of dollars that physical metal will be the safe haven when the current monetary system breaks down. You are playing the same game they are playing. You just have smaller numbers. But the strategy is identical. Accumulate physical. Hold through volatility. Ignore short-term noise. Wait for the reset. The global monetary system that has existed since 1971 is dying. The dollar is losing purchasing power every day. Real assets, hard assets, metals with no counterparty risk, they are going to preserve wealth through the transition. Silver is the most undervalued strategic asset on Earth. It is essential for every major technological trend of the 21st century. It is in structural deficit, and it is being hoarded by governments who know what is coming. So what should you do right now? If you do not own physical silver yet, buy it this week. Do not wait for a dip that might never come. Do not wait for confirmation from mainstream media. Buy while dealers still have inventory. Pay the premiums. Accept the delivery times. Get metal in your possession. If you are holding paper silver, ETFs, unallocated accounts, futures contracts, convert to physical immediately. The counterparty risk is too high. When COMEX defaults, when exchanges suspend deliveries, paper claims will be worth pennies on the dollar compared to physical metal. Do not be the person holding worthless paper when the system breaks. Watch the $84 level obsessively. That is the trigger for the next leg. When we break it, add to your position if you have capital. If you do not, just hold what you have and refuse to be shaken out by volatility. The banks will try every trick to scare you into selling. They will engineer fake crashes. They will spread FUD on social media. They will get analysts to say silver is overbought and due for correction. Ignore all of it. The fundamentals have not changed. The shortage is real. The price is going higher. And the players with real power are buying, not selling. Understand that you are not gambling. You are not speculating. You are positioning yourself on the same side as the Pentagon, China, and JP Morgan. The most powerful entities on Earth are securing physical silver because they know paper is dying, and real assets are the only safe harbor. The window to position yourself is closing. The COMEX default is coming. The Shanghai decoupling is accelerating. The resource nationalism is intensifying. And the price is going vertical. $80 today, 84 by the end of this week, 100 by end of month, 200 by March, 300 by summer. These are not predictions. These are the inevitable outcomes of structural forces that cannot be stopped by manipulation or intervention. The correction from 84 to 77 was a gift. It was an opportunity to buy at a discount before the next leg up. Most people saw it as a crash and panicked. Smart money saw it as a liquidity grab and accumulated. Now the grab is over. The stop losses have been triggered. The weak hands have sold, and the strong hands are positioned for what comes next. Do not be the person who looks back 6 months from now when silver is trading at $200 and regrets selling at 77 because you were scared. Do not be the person who sat on the sidelines waiting for a better entry while the metal disappeared and premiums exploded. This is the opportunity. Right now, Today, silver at $80 in a world where governments are hoarding it, where industrial demand exceeds supply, where COMEX is running out of inventory, where Shanghai is paying premiums, where the paper market is breaking, where Bank of America is forecasting $300. This is not expensive. This is the bargain of the century. Because we are not just watching a commodity rally, we are watching the emergence of a new monetary order where paper burns and only real things have value. Silver is real, it is scarce, it is essential. And it is about to be repriced to reflect its true strategic importance. I told you the dip was a liquidity grab. I told you not to sell. I told you $80 was coming back, and here we are. Silver closed above 80 today. The next target is 84. After that, 100. Then the real fireworks begin. Hold your positions. Trust the process. Understand that volatility is part of the game, but the trend is your friend. And the trend is up, driven by forces far more powerful than any individual trader or bank. China, the Pentagon, resource scarcity, monetary debasement, technological demand, all pointing in one direction, higher. The Great Reset is not coming. It is here, and silver is your life raft. Do not let go because the waves are rough. The storm is only beginning. And those who hold physical metal are going to emerge on the other side with their wealth intact while paper holders are wiped out. The choice is yours, but the window is closing fast. 84 breaks tonight or tomorrow. And when it does, the next chapter begins. Be ready.